All right. Hello, everyone. Good evening. We are going to go ahead and get started in about 30 seconds or so. If you're just now joining, you are in the right place. So stay tuned with us while we hang out, and we will see you real soon. All right, and we are back. We're seeing the viewers start to roll in. Hello, everyone. Thank you for joining us tonight. My name is Sophie Matthews, and I am the Student and Recent Graduate Engagement Specialist with the CSU Alumni Association. I want to thank you all for participating this evening and for tuning in with us. As we're opening tonight, as you can see on the bottom of the screen, please go ahead and test out that comment feature. That's how we're going to be doing questions, comments throughout the program tonight. So go ahead and put in the comments where you are watching from, and if you're an alum, what year you graduated. Wherever you are tuning in from, we are so glad that you are here, and I'm happy to introduce my partner over here in just a second. This event is part of our Young Alumni series, which we partner with Canvas Credit Union on, with the hope of providing some resources on applicable life skills and topics for both of us, for both those of us who are newer alums, as well as those of us who may not have recently graduated, but are equally as interested in the topics. We're really excited to bring our alums from all different backgrounds together and bring us together through programming like this that represent you, as well as educate, inform, and sometimes hopefully entertain you. So go ahead and keep trying out that comment section for me. If you can, if you can find it, that's how we'll be doing our Q&A and our questions, as well as comments throughout the session. This is Young Alumni Credit Scores, and to kick it off for you officially, I'm happy to introduce my friend Nancy with Canvas Credit Union.
Hi, everyone. Thank you so much for hopping onto a call in the evening about credit scores. I hope you're curious. These sessions are always a lot more fun if we have some people who are willing to maybe ask the awkward question or comment or share their own experience. And Haley, welcome. Glad to have you with us tonight. So just keep those comments coming. I'm going to ask you some things as we go, and it's so much more fun if everybody kind of jumps in. I would love to start with the question of, do you think that you already know your score? Have you at some time recently, maybe in the last year, looked at your credit score? And also, have you ever looked at your actual report, pulled that report and taken a look at all those different line items that are on there? So love to know if you think you know what your score is, and if you have looked at that report. My name is Nancy Patton. I'm with Canvas Credit Union, and we just so appreciate the partnership we have with CSU, and particularly the Alumni Association, to have this chance to just talk about money issues, to talk about finances. So the topic that we're doing tonight, this credit score thing, there is a lot of misinformation out there. And so one of the things that we really want to be sure to do is give you the chance to make sure, if you have a question about, well, I heard this or I thought that, please let us know so that we can make sure how to get y'all up to speed on what the real truth is about this stuff. So thanks for being open to that. And we are going to hop into a conversation very fast about what we're just going to talk about tonight. It's some real basics about credit scores. We'll just talk through basic information about that. We will include what is and what isn't part of your score. We're going to talk about how the things you do, the actions you take, impact your score. We will be sure that you have specific tips on how to manage your score, and we'll talk about reports and scores, how to get those and see what's there. I do want to make a comment about our current economic climate. It has made credit scores more important than they have been for many years. With loan rates higher than they've been for a long time, the credit score impact is bigger than it has been for a long time. So if ever there was a time for you to be interested in what's going on with your score, this is it. It really can make a huge difference in your financial life. And so I just want to ask you again a couple questions. And Haley, I appreciate your participating in the comments. If anyone else wants to join in, I'm curious if you all know what the average credit score is at the moment. So taking some guesses from you about what you think the average credit score is. And my second question for you is, does your income impact your credit score? So two things, if you want to put a number in there about what you think the average credit score is at the moment. And then does your income affect your credit score? And while y'all are thinking about that, we'll start through some conversations about those questions and some other ones. Okay, so thanks, Haley, for taking a stab at that. And I will tell you that most people guess too low on what the average credit score is at the moment. So we'll reveal that in a second. Here's some just general information about credit scores. It is a risk predictor, and it's just a 3-digit number that says how likely you are to repay a loan if you take a loan. Credit scores are a snapshot in time, which means they constantly change. The information that creates a credit score is found at the 3 bureaus, the 3 main credit bureaus, TransUnion, Equifax, and Experian. And excuse me, Tom, I already fed them. And the scores change because the information that is at the credit bureau changes. The other thing you should know is that there are other scoring models. I don't know if anybody's heard of a Vantage score, but most people, when they're thinking about their credit score, are thinking about their FICO score. And those are based on formulas from the Fair Isaac Corporation, FICO. So the Fair Isaac Corporation. And this is a flow chart about how you get to a number. So when there's a credit score that is created, it started with you having some interaction with a lender. Maybe you got a credit card. Maybe you took out an auto loan, but you have some interaction with a lender. And then every month, your lender tells the bureaus about what you're doing with your loan. So the first month that you open a loan, the lender tells the bureaus, hey, this person opened up a new loan. The next month they say, oh, they paid on time. The next month they say they paid on time again. The next month, maybe they say something like, ooh, this payment was late. After a while, the lender is going to report that you closed the loan, you paid it all off. So every month, what you do with your loan payments is reported to the bureaus. At some point, as that information is building up at the bureaus, as months go by, somebody's going to want to see your score. And so they pay to have the score created using the formulas that are there. So the information about you and your lender relationship, what you're doing with those loans. It goes to the bureaus. There are formulas that the information runs through to create a score that someone has asked for. So the scoring formulas can change. For instance, in 2022, those bureaus, they changed how they include medical debt in the formulas. In some cases, it stopped being an impact. And there are other things that have happened over time based on what's going on in the economy where those formulas change. So there are different versions of those math formulas. And that can make things confusing when people say, well, my score is this, or what's your score? Well, there are kind of a lot of scores out there. And it depends on what system's being used, what version is being used. So the big takeaway here really is that things change. And the more you can have a positive interaction with your lender, the better your score is going to be. Because what happens with the bureaus and the formulas, it's going to change over time. It's going to change with economic conditions, and you can't control that. So what you can control to create a good score is what you do with your lender. So here's just a couple more quick facts about this situation. I said there were a lot of different versions. Just the FICO scores, the Fair Isaac Corporation scores, have 28 versions. And those scores range from between 300 and 850. And here's your answer on the average score. And you can see how it's changed. This is probably over 3 years' time that every time I check what the average score is, it's moved up for a long time, went from 711 to 14, 16, 18, and it just dropped. This is the first time I've seen it drop in several years. But average score is in the 700s. And millions of scores are purchased every day. It's a purchased product. That information that's being stored at the bureau, if a lender wants to see it, if someone else wants to see the score, we pay for that privilege. You don't pay if you want to see depends on the system. Even you may have to pay to see your own score, depending on what version's being used. So, the other thing I think I want to stress when we're just talking about some basics on this is that it's not a requirement that you have an 800 credit score for you to get the best deals and have great lending options. If your score is about 740, you are going to have amazing offers. You're going to have quick answers. You're going to get great deals. 740 and above at this point is really a rock solid credit score that's going to serve you very well. So don't worry too much about having that perfect score. Those of us who have been in the industry for a while, I'll never see perfect scores. We seldom see scores over 800. It just doesn't happen that way. There can be some questions about how you get started to get a score, and does your score, I get this question a lot, does my score start at 300 and then it gets better? So that's really not the way it works, and this is an odd scoring range. I mean, I just can't stress that enough. Who figures out what's the middle of 300 to 850, and is the middle really good? And what a weird range. So in general, when you get started, if you don't have a lot of loans, or if your loans haven't reported for at least 6 months, you won't have a score at all. Then when you get a score, it probably will be around 700 or so. And then it'll fluctuate as you do your behaviors, as you pay your loans, or if you're late, if you open up some new accounts, that kind of thing. But most people don't start in that low range and build. People kind of start in the middle, and then it tweaks from there. So again, I encourage your questions. If you can use that comment feature and shout out those questions to us about how this stuff works, because it doesn't make a lot of sense in a lot of ways. All right, let's talk about why people care about their scores. There's general knowledge. It's really important to have a good score, but why? Here's just one example of why people care about their scores, and it's related to the interest rate that you're going to pay when you borrow money. And like I said, the interest rates right now are higher than they have been when you get a loan. And so it really can impact how much money you're going to spend on loan interest, depending on what your score is. So in this example, it's one car loan for $30,000. It's for 60 months. The only difference between these two people, person A and person B, is that one has a lower credit score than the other. That's impacted the interest rate they're going to pay. It impacts the monthly payment. And it most assuredly impacts the total interest over the life of the loan. So this is just one example of why people care about their credit scores. It does absolutely impact the interest rate you'll pay when you get a loan. But there are some other things going on with credit scores as well that impact your overall financial life. So insurance companies look at your credit information to determine how much you're going to pay for your insurance. This is your homeowner's insurance, auto insurance. This is going to impact what that premium is that you pay to obtain insurance. Landlords look at your credit information. So I have a single little rental that my husband and I do. And when we are searching for a new tenant, we do look at their credit. If you get into a big apartment complex, absolutely, those people are going to be looking at your credit. If it comes down to someone, you both have income, it both seems like you have the ability to pay for the rental, but one of you has a better credit history, that's probably who's going to get the apartment. Some other places that look at your credit information are utility companies when you're signing up for new utilities. If your credit score is low, you may have to pay a deposit, and someone with a higher score might not have to pay that deposit. Phone companies, cell phone companies can base their decision about whether you get a phone or how much it's going to be. And cable companies, all of those can require customers to have a deposit before they receive service. There are employers who will look at your credit report. In Colorado, it is not allowed to base a hiring decision on credit information, except in certain industries. So if you're looking to get into the finance world or insurance world, those places can look at your credit and make a hiring decision based on what they see. And other parts of the country don't have that protection that Colorado law has. So there are some other things that are impacted. Military security clearance, opening a bank account can be impacted by that. So there are lots of other things besides that. What's my interest rate going to be on a loan? Lots of other reasons why people care about their credit scores. So I said we'd talk about what is in your score and what isn't in your score. Let's take a look at some details about that. This is another thing that has a lot of confusion. I asked you to think about whether your income would be part of it. So let's start on the left side of the left column there. Some things just don't appear anywhere. Not part of the report, not printed out, not part of the scoring system, absolutely nothing to do with your credit. There's quite a list there, including your income, what your job title might be, banking information, and arrests or any kind of criminal activity. This is not part of the scoring system. It doesn't appear anywhere on the report. If you pull your report, The right column lists some things that you might see. It might list an employer and your address, this kind of thing, but it's not part of the scoring system. It's part of the report, but not part of the score. And I also want to say that those things like address and employer are only going to show up on the report if you applied for a loan when you lived at that address or when you worked for that employer. So it's not an exhaustive list of your employers. It's a list of the people you said you worked for when you applied for a loan. Okay, we're going to keep rolling on some things about if that's not on your report, then what is on your report or what does impact your score? These categories are the things that impact your score, and you'll see that some are more important than others. Some have a bigger impact. We're going to talk through each one of those one by one, but here's just a general look at all the factors that go into the scoring formulas. And now we'll talk about each one and how they figure into the process here, figure into those formulas. The biggest part of the scoring system, the biggest part of the formulas that make up your score are, did you pay your loans on time? This is not, did you pay your utilities on time? This is, did you pay a loan on time? It's a credit score. It's all about credit, and things like utilities are not credit. So your payment history is 35% of your score. Did you pay on time? The biggest thing that we can encourage, if you've fallen behind, if you missed a payment, and life happens, we do that. We move, and the bill gets lost in the mail. Life just gets kind of crazy some months, and we miss a payment. Getting caught up, if you fall behind, will bounce your score back. It's not going to bounce it back quite as high as it used to be, but it's going to bounce it back. So if you've been late on a payment, get caught up as soon as you can. There's a comment here about, what if you don't have credit history? What if you don't have loans going on? Can you get rent or utilities to be part of your score? And the answer is yes, but there are some special programs involved in that. It's not part of the standard credit reporting system. So this isn't right for everybody, and I'm not going to encourage everyone to jump into this. But if for some reason you don't have a lot of credit history and you're eager to build that credit, you can look into a couple of programs. They're listed on the screen: Rental Karma and Experian Boost. They're limited. They only apply in certain circumstances. There might be payment involved for this ability to have these things reporting. So it's not for everyone. I just want to make you aware that it does exist. So if payment history is the most important part of your score, paying on time, there are some tweaks within that we need to consider. How much your score is going to be hurt with a late payment is determined by several factors. One is how much money was involved. Was it a $10 late payment or was it a $1,000 late payment? The frequency of the lateness. So are you late 5 times a year, or were you late once a couple years ago? And then how recent the last late payment was. Did it happen just 2 months ago, or was it several years ago? So the impact on your score is determined by a dollar figure involved, how often you're late, and how recently you were late. Again, this is the biggest part of your score. So if you're going to manage your score, managing this part of your behavior with your loans is the biggest way to improve your score or to keep your score high. The next thing that we're going to talk about is the next biggest category of the scoring system, and it's how much you owe. And it has some complications in it. So please, if you have questions about it, put them in the comments. This is going to be thought of in a couple different ways. One is just overall, how much debt do you have? And then how many accounts do you have open that have a balance on them? Another way that this is impacted in the scoring system for this category is if you opened an installment loan, and that's like a car loan. If you opened a car loan and you just did it, you've got a lot of money out there right now. If you opened a car loan 3 years ago, you've paid that balance down and there's less remaining on that installment loan. And so your score isn't as impacted. Another thing that can impact your score in this category is revolving accounts. So installment loans are like car loans. We know exactly how long they're going to last. You make an equal payment every month at the same time. Revolving loans are like credit cards, and we don't know how you're going to act with those. You might put a lot of money on your card one month, pay it all off. You might not use the card at all. You might put a lot of money on there and pay it off in little bits. So with revolving accounts, they don't really have an ending, like a car loan has an end. And revolving accounts can change every month. And so the scoring system likes to see you handle both an installment loan with that predictable payment and a credit card with that unpredictable payment. So simply the fact that you have a credit card will probably help your score. And if you manage that credit card well, it will really help your score. I hope you've heard that you shouldn't max out your score or max out your credit card. So if your limit is $1,000, you want to only be using $200-300 of that on a monthly basis. If you have $1,000 limit and you use $999, I guarantee you your score is going to drop. The scoring system wants to see you not max out the amount that you've been approved for. And that's sort of called capacity. That's how much you're using out of what you've been approved for. And it's based on what shows up on your statement. So I'm going to show you an example in a minute of how I had a limit, and sometimes I used a lower amount, and sometimes I used a higher amount, and how it impacted my score. This can be confusing, this how much you owe section. So again, I welcome your comments or questions if you have them about this part of the scoring system. Here's an example. This is from some home banking that Canvas offers. You can see what happens when I used a lot of my credit that's available. That top graph shows my score. The bottom graph correspondingly shows how much I used out of my limit. So you can see on the bottom graph, I was using 21%, and later on I went back and was using 19%, 22% of my limit. But that 1 month, I used 55% of my limit. And what happened to my score? It took a 56-point drop. So this is a very clear example of how you want to manage your credit card use, where whatever amount you've been approved for, we don't want to be using too much of it. We want to use a little bit of it, and your score will stay great. So paying your loans on time, not maxing out your credit cards, those two things alone account for more than half of your score, and just managing those two things can help your score stay strong, get strong. So this is, I really like this very vivid example of how that credit card use impacted my score. The next category of things that impact your score are the length of credit history. So simply, how long have you been in the system? What's the age of your oldest account? When did you open your last account? What's the average age? All of these things make up 15% of your score, and it is, again, just simply related to if you're brand new in the system, this part of the scoring points just aren't going to be very strong for a while until you've built some history. So those people who have been in the credit scoring system for a long time, they're getting some advantages in their score simply because they've been doing this for a while. Hopefully they've been doing it well for a while. One of the things you may have heard is that you shouldn't close your old credit cards. You should leave them open. This is the reason why. If you can leave your cards open, it will give you that longer age of oldest account. It'll keep your average age higher. Sometimes people just don't want those cards open. This is only 15% of the scoring model. So if you're uncomfortable having the credit card open, please close it. If it's a fraud risk, please close it. It's not going to impact your score that much. And we don't want you to be tempted to overspend by having that card open. If there's another reason for you to close the card, please close the card. But if you can manage it, leave it open, because it will help this section of the scoring model. The next part of the scoring system also gets some confusion and a lot of misinformation. 10% of your score is related to, are you looking at new credit, or did you just open new credit? And there's a couple things impacting it here. One is the inquiry. Did somebody take a look at your score? And the second part of this section of scoring is, did you actually open up a new loan? So let's start by talking about those inquiries. You're going to lose a few points. And I have to say that sometimes I'm using examples about how many points you might lose. This is based on research, on learning history that we've had. But this varies a little bit. It's not a scientific formula that you will lose 5 points or you will lose 60 points, anything like that. So a little grace as we talk about this. This is approximately what will happen to your score based on these activities. If you ask for a loan, that is a hard inquiry. You are saying, please give me a loan. Please give me credit. I want to borrow money. That's probably going to drop your score. And that score drop seems to stay off of your points for a year and then kind of magically reappears after a year. If there are some exceptions to this, so keep in mind, this was you asked for a loan, you wanted to borrow money. If you look at your own score, if an insurance company looks at your score or an employer looks at your score, this does not drop your score. You said you could look. You said, please look at my score, look at my report, but you're not asking for a loan. The other thing that won't drop your score is if you didn't say, look at my score, and someone just did like a pre-approved credit card. You haven't asked for that loan. And so the pre-approval offer that comes didn't drop your score. The other thing that's going to impact this process or this part of the scoring system is if there were multiple inquiries, but they're all about one kind of loan. So we want you to be a smart shopper. If you're going to go buy a car, we want you to look around. We want you to find a great auto loan rate. And that means that multiple lenders are going to look at your score. But it's all related to buying one car or getting one student loan or getting one mortgage. So depending on the scoring system that's being used, remember there were lots of different scoring models. If you are looking for a same kind of loan, a car loan, within a short period of time, it only counts as one impact on your score. So we do encourage people to shop around for these big purchases. If you can do it within a couple weeks, that's going to be the safest way to make sure you're not getting hit with multiple point drops. But the scoring system, the formulas understand that you're not buying 10 different cars because you went to 10 different lenders. You're buying one car and you were shopping around. The trick is to do it within that short time frame. Okay, so that's all about the inquiries, the difference between when it impacts your score and when it doesn't impact your score. And then the next part of this scoring chunk, this 10% of your score, new credit, is related to, did you actually open up a loan? Sometimes people go shopping for loans, but they don't actually open one up. So the example I like to use is if you were shopping, Target, Kohl's, somewhere doing some shopping, and they say, hey, you could save $8.95 on your purchase today if you would just open up a new blank card. And so you say, sure, let's do that. I've always kind of wanted to have a Kohl's card. And they do an inquiry and they open a new credit card for you. You probably just lost about 15 points off your score, and those 15 points are going to stay off of your score for a year. Now, if you had looked at Kohl's and said, yeah, go ahead, let's look at opening this credit card, and they pulled your score, but you changed your mind. You said, no, you know what? You took a look at my score, but I'm not going to open the card. Now you've only had the inquiry point drop. You didn't lose the new loan points. So where this comes into being a challenge for people is if they aren't thinking about this and they go to Target, and they go to Kohl's, and they go to Best Buy, all of those inquiries and all of those new cards are going to drop your score like 15 points for every single one. So that can really put an impact drop on your score if you aren't thinking about, do I really need this? Do I really want this? Is this important that I go ahead and open this loan? So we'll have some tips for you in a few minutes about ways to manage your score, but this is one of them, to be sure that you're only asking for loans, you're only having inquiries done when you really need it. All right, let's look at that last category of the scoring system. It's about 10% of your score, and this is the mix of things you have. So the scoring system likes to see you handle those credit cards because that's revolving, and it likes to see you handle a car loan. It could be a boat loan, but some kind of installment loan that's regular, and it likes to see you handle a mortgage well. We are never going to suggest that to improve your score by a few points, you go get a mortgage you can't afford, or to open a car loan you can't afford, or to have too many credit cards. But you just need to know that the credit scoring formulas like to see you have a mix of kinds of loans. So those are the categories that make up how your score gets those numbers, gets created by running through formulas. The formulas have more important aspects of what you're doing with your credit and less important aspects of what you're doing with your credit. But those are the 5 basic categories of what makes up a credit score. So the next thing we want to hop to is some specific tips, and it's based on what we just talked about, specific ways you can manage this information to your advantage. So the first thing, because that biggest part of your score is did you pay on time, is there something you can do to make sure your payments are happening on time? For a lot of people, that's some kind of automatic payment that they set up. So we strongly encourage that. The other thing that we've heard about people doing is if for some reason your payment is due at a really awkward time, it's due the day before payday, can you talk to your lender and see if they can adjust the payment date so that it's easier for you to make that payment on time? But the auto pay is really the best way to do this, setting up some kind of automatic payment so that you don't have to remember it, so it's just happening. That's really going to help your score to be consistent. Biggest part of the scoring system, did you pay on time? That second suggestion, which is keeping your credit card balances low, and the next one, which is to raise your credit limit if you can handle it, that has to do with that capacity. How much am I borrowing on my credit card? So one way to manage that is not to use very much, to have a low balance related to your limit. If for some reason you find that you are regularly paying or spending more on your card, you're paying it off every month, but for your lifestyle, you're spending half of your limit every month and then paying it off, see if you can raise your credit limit. Now, the trick, of course, is that if you raise your credit limit, are you going to start spending more? Or can you keep it at where you were spending before? And what that's going to do, if you can handle it, the higher limit but the lower spending will help your score. There's another suggestion related to credit cards, and that is that sometimes people struggle to make those credit card payments because the interest rate is so high on credit cards. The trick we can do is to get you out of credit card debt and move you into like an auto loan or move it into a home equity loan. You still have debt, but it's not on that credit card. So the advantages are that you're going to save money on interest. It can lower your monthly payment. It can help you feel better that you're knocking that debt down. You're getting out of debt. So restructuring credit card debt is one tactic that people can use to manage that part of the scoring system where they don't want to max out their credit cards. And we had a question come in about having something from every category. If you have the credit cards, you have an installment loan, a mortgage, it's great if you have all of those, but it is not a requirement. I haven't had a car loan for many years. My credit score is still very strong because at some point I had a car loan and I paid it well. I actually don't have a mortgage at this point in my life. Everybody goes through different cycles of when they're in a home loan and when they're not. I don't happen to have a mortgage at the moment. Oh, wait, I do. Sorry. But people pay off their mortgages, or people get out, they go into a rental market for a while and don't have that mortgage. It's just important to manage your total financial life, not to focus on, oh, I've got to have one of everything. The thing that really can help is to have that credit card, and it's the next point on this slide, have a revolving account. If you hate credit cards, try getting an overdraft line of credit instead. It's the same type of thing. It's linked to your checking account. You don't have to use it. You don't have to have a credit card. You can have this overdraft line of credit. It is the same type of loan, and it still reports to the Bureau, and it does what we want to do with having a great score, but you don't have to use it if you don't need to. It's free, and it's not a credit card. So that is one way that you can have a revolving account, have that category covered without having a credit card. I'd be happy to answer more questions about that one. Some people aren't familiar with the overdraft loan concept. And then keeping your cards open. This was related to that credit history. How long do you want to have? How long have you been in the system? Just the longer you're there, you're going to have a better score from the scoring system. So if you can leave your cards open, that's great. And then only open new credit when you need it. Go back to the Target, Kohl's, Best Buy scenario. If you don't need to open this, think seriously about whether you really want to have that credit line open. Those are some specific tips related to how each category is impacted by your actions, and just really encourage you to be considering some of these real specific actions. They will help you get a good score, and they will help you keep a good score. Okay, so if you've got a great score, how do you see it? How do you get your report? How do you get your score? Let's start with the reports. Annualcreditreport.com is the only place to go to get your reports, with one caveat. But be careful of imitations. There are some fraudulent sites that look similar, but it's annualcreditreport.com. The three major bureaus are required to maintain this site, and it's a central place where you go to get your reports. It does not include your scores. It is your reports. So you will go to annualcreditreport.com, and from there you'll choose, I want to see my TransUnion report, and you get that TransUnion report, download it, because you can't go back and look at it. For most of us, it's a 1 year wait before we can look at our reports again. There are still some pandemic regulations in place. At this moment in time, until the end of this year, you could actually pull your report every week if you wanted to see your report every week. Normally, it's a 1 year cycle when you can look at your report, and that means you can look at your TransUnion report. A year later, you can look at it again. Same thing with Experian. If you look at it a year later is when you can look at it again. Same thing with Equifax. So they're based on a 1 year. Some people stagger them, look 3 different times during the year, one report at a time. Some people pull them all at once because they want to verify that everything's looking good. It's up to you. It is a great way to watch for fraud because it will show exactly what's going on, who's been looking at your score, what's opened up. Sometimes people are surprised to find that something is open on their report and they weren't the one to open it. So we really encourage you to look at your report. Reports are still generated by human beings who put information into a system. Therefore, the chance for error is there. So it is really good for you to look at your reports regularly and see what that report says and that it's accurate. So that's where you get your reports. They're free once a year. You go to Annual Credit Report, and one at a time go to Experian, Equifax, and TransUnion to see the actual report. This is not your score. Where do you get your score? So there are some places where you can get a free score from either the FICO scoring system or the Vantage scoring system. If you have questions about the Vantage scoring system, put them into chat, put them into the comments. They're similar. There are some slight variations, but they are very similar. And so, but you can get those scores either from some credit cards. There are many credit card companies who realized that consumers care about their score. And so they're going to provide a free score for you. Look for the logo that it says FICO or it says Vantage to be sure it's a reputable score. There are credit unions and banks that offer this to their customers, their members. So at Canvas, we offer a free credit score to you in home banking. And the other way you can find out what your score is for free is that if you do get a loan, you can ask them, what was my score? They're not supposed to give you the report. That's part of their contract with the credit bureau, but they can tell you what your score was. And then you can pay for a score. If for some reason you really want to know what it is and you don't have access to one of those free scores, you can go to Annual Credit Report or your MyFICO and you can pay to see a score. And then there are free scores out there. And so free scores are from like Credit Sesame or Credit Karma. They don't seem to hurt you, but they're not completely accurate. If it's important to you to know what your real score is, don't trust that those free scores that you can get. So we'll paying, sorry, I'm going to take just a second and look at the comments that are coming in. Will paying off a personal loan early hurt my credit? Not really. The only challenge I would see in paying off a loan early impacting your credit poorly would be that there wasn't enough time for it to report. So for instance, if you had a loan, a car loan, a personal loan, whatever, and you'd taken it out for, you've only been paying on it for a couple months, you managed to get it paid off really quickly, it wouldn't have had time to report your good behavior of paying on time. So that would be something that I would encourage you, just to be sure you've paid for at least 6 months or so on a loan to establish that good history. Otherwise, the sooner you can get out of a loan, the smarter you are, because you're avoiding interest. So that's the only caveat, is to be sure it reports to the system. But otherwise, absolutely pay it off early and be done. Congratulations. And then, can you dispute items on a credit report? Yes, absolutely. So each bureau, credit union, TransUnion, Equifax, and Experian, each one is going to have their own dispute process. And so you would go through whatever their system says as, hey, this is wrong. You will probably have to prove with some paperwork. They are required within a certain time frame to act on that dispute. So each credit bureau would have the dispute process on their website on how to do that. Okay, so that's how to get your reports. Go through annual credit report, and then how to get your scores. And again, a variety of ways where you can do that depending on if you want to pay or not. A couple times I've kind of hinted at something that is available through Canvas. That's where I got my that screen that showed my score dropping so much because of my credit usage. We have, and we're not alone, there are other financial institutions that use something called Savvy Money, and it's an amazing tool. I cannot speak highly enough of this. It will help you see your score. It will help you. That's where that report that you saw with my score dropping came from. It will tell you what actions have impacted your score. It has a simulator where you can put in, okay, if my credit card balance is, $5,000 and I pay off $3,000, what will happen to my score? If I open a new car loan for $25,000, how will that impact my score? So it has a simulator. It has some educational features. I just am very, very pleased with Savvy Money and the educational side of this. It does use the Vantage scoring system. So you'll see a little difference between what your score is in Savvy Money and what your score is using FICO. But the education process is very, very good here. So this is an option that's available if you have Canvas accounts, home banking, and there are many other financial institutions, banks, and credit unions that use Savvy Money. So you might look in your home banking and see if it's an option. When we talk about credit scores, often there are people who have, for some reason, struggled with credit and with taking on too much credit. So there are also many credit unions and banks that offer a counseling service. It's a national nonprofit called GreenPath. And GreenPath specializes in debt management plans. There are fraudulent companies, there are scams out there related to debt management. Please be very careful that you are choosing a reputable source if you are looking into some kind of debt management plan. They can help you review credit reports. They can help you with basic budgeting. They do student loan counseling. This is a hot topic at the moment with the student loan payments coming back. They have trained counselors to help you understand the different repayment options available on student loans. They do some home buyer counseling, lots of different things related to financial wellness. And many credit unions and banks offer Green Path. Canvas does. It is as a free resource, or there may be a sliding scale for some particular services. But again, I want to stress that this is an area that can have fraudulent activity associated with it. Please be very careful. You are using a trusted resource if you're going to do anything around debt management or a debt repayment plan. This area is rife with fraud. Please be very careful that you have a trusted resource. And that's the content of what we were going to talk about tonight. I want to encourage you to keep putting questions in. If you have questions, to use that comment section. And Sophie, I'll let you wrap us up. There's a couple things I know that this video is able to be viewed again because it posts directly on YouTube. So take it away, Sophie. And keep the questions coming if you have them. Since we apparently have lost Sophie.
Nope, I'm here. I'm here. Oh, sorry, everyone. Thank you for your patience with me. Thank you all for joining tonight. On behalf of the CSU Alumni Association, we are so glad that you took some time out of your night or your morning if you're watching from somewhere other than Colorado. So we are very thankful to have you join us. Nancy and I are going to hang out for a little bit longer if anyone has any questions. So go ahead and keep popping those in the question or in the chat there. And I just want to give a big thank you again to all of our CSU Alumni Association members for making events like this possible. Yeah, thank you all so much for joining. Have a great rest of your day and go Rams. Again, we'll be hanging on for a little bit longer and you can view this immediately after we are done recording, as it will be immediately posted to YouTube at the same link. All right. Thank you all. Go Rams.
I'll echo that. Go Rams. They're going to have a tough one this week.